Ever wondered how to make your money work for you even when you're not working? Dividend investing might be the answer you're looking for. This intriguing financial strategy is all about buying stocks in companies that dish out a portion of their profits to their shareholders. These payouts, known as dividends, can provide a steady flow of income over time. Imagine having a golden goose that lays golden eggs at regular intervals. That's what dividend investing can feel like. The best part? These stocks often hail from large, established companies that have stood the test of time. They're like the sturdy oak trees of the financial world, providing a consistent source of income that can weather economic storms. So if you're seeking a way to earn a steady income from your investments and don't mind playing the long game, dividend investing might be worth your consideration. Now that you know what dividend investing is, let's dive into how to select quality dividend stocks. When it comes to choosing dividend stocks, it's crucial to focus on companies with strong financial health. You want to invest in businesses that are capable of not just surviving but thriving in various market conditions. Look for companies with a low debt-to-equity ratio, robust cash flow, and a history of profitability. These characteristics often indicate a firm that can sustain and potentially increase its dividend payments over time. Consistent dividend payments are another essential factor to consider. Companies that have a track record of paying dividends are likely to continue doing so in the future. It's not just about the company's willingness to distribute profits, but also its ability to generate consistent earnings to support these payments. So where do you find these top dividend stocks? A useful tool at your disposal is Seeking Alpha. This platform offers a wealth of information on various companies, including their financial health and dividend history. Here's a quick step-by-step guide to help you navigate this resource. Step 1. Head over to Seeking Alpha's website. On the homepage, you'll find a search bar where you can type in the name or ticker of a company you're interested in. Step 2. Once you've selected a company, you'll land on a page that provides an overview of its financial performance. Here, you can find crucial data like the company's earnings, cash flow, and debt levels. Step 3. Scroll down to the dividends section. This part of the page offers insight into the company's dividend history. You'll see whether the company has been consistent in its payments and if it has a history of increasing its dividends. Step 4. Repeat this process for several companies. This will allow you to compare different stocks and make an informed decision on which ones to add to your portfolio. This process may seem a bit tedious, but remember, investing is not about making quick decisions. It's about conducting thorough research and making informed choices. This approach will help you build a portfolio of quality dividend stocks that can provide you with a steady income stream for years to come. Now, it's important to note that while Seeking Alpha is a valuable tool, it shouldn't be your only source of information. Be sure to consult other financial news outlets, read companies' annual reports, and consider speaking with a financial advisor. These additional steps can provide a broader perspective and help you make more informed investment decisions. Remember, the key to successful dividend investing is picking companies that are financially healthy and have a track record of consistent dividends. So take your time, do your research, and start building your portfolio of quality dividend stocks today. In the world of dividend investing, you'll often hear about high-yield and dividend growth stocks. But what's the difference? Let's start with high-yield stocks. As the name suggests, these are the stocks that offer large dividend payouts, often higher than the market average. This might sound like a golden ticket, but remember, high rewards often come with high risks. If a company struggles to maintain these generous payouts, it can lead to a significant drop in stock price. That's why it's crucial to examine a company's financial health before diving into high-yield stocks. Now, let's talk about dividend growth stocks. These stocks might not wow you with their initial payouts, but they hold a secret weapon: growth. Dividend growth stocks are typically from companies that have a track record of increasing their dividends over time. This means that while the initial payout might be smaller, it tends to grow year after year, often outpacing inflation. So, why does this matter? Well, over the long run, a steadily increasing dividend can result in higher total returns. This is especially true when you consider the power of reinvesting those dividends, which we'll delve into later. But there's more to it. Companies that regularly increase their dividends are often financially stable and well-managed. They're the type of companies that tend to weather economic downturns and come out stronger on the other side. These are the qualities that can make dividend growth stocks a more sustainable and less volatile investment than their high-yield counterparts. In the end, the choice between high-yield and dividend growth stocks depends on your individual investment goals and risk tolerance. If you're in search of immediate income and are willing to take on a bit more risk, high-yield stocks might be the way to go. However, if you're looking for a reliable income stream that can grow over time, and you're willing to be patient, then dividend growth stocks could be your ticket to long-term financial success. While high-yield stocks might be tempting, dividend growth stocks often provide a more reliable and sustainable income stream. Let's talk about the snowball effect in dividend investing. Picture a small snowball at the top of a hill. As it rolls down, it picks up more snow, growing larger and faster. This is the essence of the snowball effect, and in dividend investing, it's all about reinvesting. When a company pays you dividends, you have a choice. You can take the cash and spend it, or you can reinvest it back into purchasing more shares of the company. With each dividend payment, if you choose to reinvest, you're essentially buying more shares, increasing the number of dividends you'll receive in the future. This process, known as dividend reinvestment, is like rolling that snowball down the hill. With each reinvestment, your snowball, or in this case, your investment, grows larger. Over time, the effect can be substantial. The beauty of the snowball effect lies in the power of compounding. Compounding is the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. This might seem slow at first, like the initial roll of a snowball, but as time goes on, the growth becomes more noticeable, more substantial, and before you know it, you're looking at a sizable snowball of wealth. But here's the catch. Just like rolling a snowball requires energy and patience, the same goes for dividend investing. It takes time. The snowball effect in dividend investing isn't an overnight process. It requires consistent reinvestment and a long-term perspective. In the words of the renowned investor Warren Buffett, "Someone's sitting in the shade today because someone planted a tree a long time ago. The dividends you reinvest today are the seeds of the wealth you'll enjoy tomorrow." Let's not forget, the larger your initial investment, the larger your snowball starts and the faster it grows. But even if you're starting small, don't be discouraged. A small snowball can still roll into a sizable mass given enough time and the right conditions. By reinvesting your dividends, you're essentially rolling a financial snowball that can grow into a substantial income stream over time. Now let's get practical. How can you build a diversified dividend portfolio? Building a dividend portfolio isn't just about picking stocks with the highest yield. It's about striking a balance between yield, growth, and stability. In other words, you want to select stocks that not only pay a good dividend but also have the potential for future growth and are financially stable. To evaluate the financial health of a company, you can use a number of key financial ratios. These include the payout ratio, which tells you what percentage of the company's earnings are being paid out as dividends. If this ratio is too high, it could mean that the company is not investing enough in its own growth. On the other hand, the debt-to-equity ratio gives you a measure of a company's financial leverage. Companies with high debt-to-equity ratios may struggle to maintain their dividend payments if they hit a rough patch. Finally, you'll want to look at a company's earnings growth. Companies that are able to consistently grow their earnings are more likely to be able to increase their dividend payments over time. Now, let's talk about some examples of stocks that could be good additions to a dividend portfolio. First up, we have NRG Energy. This company has a solid dividend yield and has been steadily growing its earnings. It also has a relatively low payout ratio, which suggests that it has room to increase its dividend in the future. Next, we have Kroger. This supermarket chain has a history of consistent dividend payments and has a healthy payout ratio. It also has a low debt-to-equity ratio, which suggests that it has a strong balance sheet. Then there's JP Morgan Chase. This financial giant offers a decent yield and has a good track record of growing its earnings. However, its payout ratio is a bit on the high side, so you'll want to keep an eye on that. NextEra Energy is another good option. This utility company has a good yield, a low payout ratio, and a low debt-to-equity ratio. Plus, it's been consistently increasing its dividend. Finally, we have L3Harris Technologies. This defense contractor has a modest yield, but it has a very low payout ratio and a low debt-to-equity ratio. It also has a strong track record of earnings growth. Of course, these are just examples. The key is to do your own research and select stocks that fit your own investment goals and risk tolerance. Remember, building a dividend portfolio is a long-term endeavor. It's not about chasing the highest yield. but about finding sustainable dividends that can provide you with a steady income stream for years to come. Building a diversified dividend portfolio can provide you with a reliable income stream and help protect your investments from market volatility. Finally, let's discuss some strategies for dividend investing. As we navigate the world of investments, it's crucial to realize that there's no one-size-fits-all approach. Different strokes for different folks, as they say. So let's break down two strategies that cater to varying financial circumstances. First, we have the lump sum investment strategy. This is ideal for investors who have a large amount of money to invest up front. Imagine you've come into a windfall, perhaps an inheritance or a bonus from work. Instead of letting this money sit idle in a bank account, a lump sum investment in quality dividend stocks can get the ball rolling. Here's how it works. You invest your lump sum into a basket of dividend stocks. These companies, in turn, pay you a portion of their profits as dividends. Over time, the dividends you receive can be reinvested back into these stocks, allowing your investment to grow exponentially. Now, let's talk numbers. If you were to invest a lump sum of, let's say, $100,000 into a portfolio of high-quality dividend stocks, with an average yield of 3%, you'd receive around $3,000 in dividends in the first year. If you reinvest these dividends, your investment could grow to over $191,000 in 10 years, assuming an average annual growth rate of 6%. On the other hand, we have the dollar-cost averaging strategy. This strategy is suitable for those who prefer to make regular monthly contributions. Instead of investing a large sum all at once, you invest a fixed amount every month, regardless of the stock price. This strategy takes advantage of market fluctuations. When stock prices are high, your fixed monthly investment buys fewer shares, but when prices are low, you scoop up more shares. Over time, this could result in a lower average cost per share, potentially boosting your returns. Let's crunch some numbers again. If you were to invest, say, $1,000 monthly into dividend stocks, with an average yield of 3%, your portfolio could grow to over $236,000 in 10 years, assuming the same average annual growth rate of 6%. Now, these are just projections and actual returns may vary. Remember, the stock market is not a get-rich-quick scheme. It requires patience, discipline, and a sound strategy. Whether you choose the lump sum approach or the dollar-cost averaging strategy, the key is consistency. Consistently investing in quality dividend stocks and reinvesting the dividends back into the portfolio can yield substantial income and growth over time. Remember, Rome wasn't built in a day. Similarly, wealth accumulation is a long-term game. It's about planting seeds today for a bountiful harvest tomorrow. Regardless of your initial investment amount, with patience and a sound strategy, dividend investing can lead to substantial income and growth over time. So there you have it, a comprehensive guide to dividend investing. We've journeyed through the basics of earning steady income from big, stable companies to selecting quality dividend stocks using tools like Seeking Alpha. We've weighed the pros and cons of high-yield versus dividend growth stocks, understanding that while the former offers larger initial payouts, the latter provides a more sustainable and beneficial growth over time. We then explored the Snowball Effect, highlighting the magic of reinvesting dividends back into buying more stocks, creating a compounding effect that grows your investment over time. We also discussed how to build a diversified dividend portfolio, selecting stocks with strong financial health and consistent dividend payments. And finally, we outlined strategies for both lump sum and regular monthly investors. Remember, the key to successful investing is not timing the market, but time in the market. Keep learning, stay patient, and let your investments grow. We hope you found this guide to dividend investing helpful. Now it's time for some interaction. If you have any thoughts, questions, or your own dividend investing experiences you'd like to share, please leave them in the comments below. We love hearing from you. If you found this video informative, give us a thumbs up. Your support helps us create more content like this. And if you haven't already, click that subscribe button and bell icon to get notified of our latest investing tips and guides. Thank you for watching, and here's to your journey in dividend investing. Happy investing.